Good evening, everyone. My name is Arthur Robinson Jr. I'm the creator and host of the Powerful Interviews podcast, along with two successful entrepreneurs, Brandon Ball and Elliot Jackson. They used to play for the Cincinnati Bengals. And tonight, I have a special interview for each and every one of you. Tonight, I have a wonderful person on the show. He's a great friend of mine. His name is Tom Wheelwright. Tom Wheelwright is a certified CPA, and he is the CPA for the famous entrepreneur Robert Kiyosaki, the author of the international best-selling book Rich Dad Poor Dad. And I have his phenomenal book right in front of me. And the title of the book is called Tax-Free Wealth: How to Build Massive Wealth by Permanently Lowering Your Taxes. And that is an awesome, impressive resume. Without further ado, I'd like to welcome the one, the only, the powerful Tom Wheelwright to the show.
Hey, thanks, Arthur. Great to be here. Nice to see it. Nice to be on with everybody. Always love talking about my favorite subject, taxes.
Well, I'd like to thank you, Tom, for taking time out of your busy schedule to educate me and the audience worldwide about the power of eliminating taxes and the power of building wealth. I gladly appreciate it.
Yeah, absolutely. Always happy to be on your show, Arthur.
To everyone that's listening, I highly recommend go and get your pen and your pad right now. My great friend Tom Wheelwright is going to break down layman's terms about the power of building wealth. And we're going to talk about how you can eliminate your taxes, which that'll put more money in your bank account. Is that correct, Tom?
Absolutely. And we're going to do it legally.
Can you explain to the audience in layman's terms, for people that don't know you, who is the phenomenal Tom Wheelwright? How long you been in your powerful industry? And what is your expertise?
So for those of you who don't know me, I grew up in Salt Lake City, Utah, and started my education at the University of Utah, where I got my Bachelor of Arts in Accounting. Then I went to the University of Texas, where I got my Master's of Tax from the University of Texas. From there, I spent 7 years at Ernst & Young, the largest CPA firm in the world now, and including 3 years in the National Tax Department. So that's where I created courses, taught them to other CPAs around the country. I was there the last time we had major tax legislation before 2017, which was 1986. So that tells you a little bit about how long I've been in this business. And so when I left Ernst & Young, I became the in-house tax advisor for a Fortune 500 company. I did that for several years, and then I decided that it was time to go with my passion, which was serving entrepreneurs. And I started my first CPA firm. I actually started with 2 clients and beat the streets and did really well. And after 9 months, I doubled my business. So yeah, I had 4, right? So those of you who are entrepreneurs, which I presume is most everybody here, understand that, boy, that first few months can be challenging. Then I actually learned that you can actually buy a CPA firm. So I went out and bought a CPA firm. My buddy actually loaned me the money to buy a CPA firm, and I started my first CPA firm 25 years ago. And at the time, I'd also been asked to create a course at the Arizona State University in their Masters of Tax program, and I taught that course for 14 years while I was building my business. Since then, for the last 20 some odd years, I've been a Rich Dad advisor, meaning that I get to travel the world with Mr. Kiyosaki. We were just in Romania, Warsaw, Poland, and London, England. And we spoke to thousands and thousands of entrepreneurs and investors there. And it's great being able to speak with them around the world. Also, we have an international network of CPAs, and that's my big project right now, is developing a network of CPAs. Every time I go somewhere, I get 2 things will happen. Mm-hmm. So the first is somebody's going to come up to me and say, where can I find somebody like you here? Okay, that's the first question I'm going to get.
Mm-hmm.
And then I'm always going to, and I actually get that from several people. And so we've decided to build this network of CPAs. But the other thing I get, which is fascinating, is sometime during the event, somebody's going to come up to me and say, Tom, this is great information, only you can't do that here. And it doesn't matter if I'm in Bucharest, Romania, or Warsaw, Poland, or frankly, if I'm in Dallas, Texas, somebody's going to come up to me and say, this is great information. It's just you can't do that here. And what I'm hoping we're going to be able to do for the next few minutes, Arthur, is actually discuss how you actually can do this here if you have the right information and the right understanding of how the tax law works. Because fundamentally, understand that the tax law, and you know this, Arthur, the tax law is fundamentally a series of incentives. And it's a series of incentives for primarily business owners and investors. So basically what we want to do is we want to figure out what those incentives are, figure out what the government wants us to do, and just do what the government wants us to do. When we do that, we can get, that's frankly how we get to tax-free wealth.
Mm. Wow. Now, Tom, we have a lot of entrepreneurs in our network that are into real estate investing. They're into, flipping houses, rehabbing houses, purchasing apartment buildings. And let's break down the benefits of cost segregation. And for the people that don't know what cost segregation is, what is cost segregation? And how can people take advantage of that by investing?
Let's start from the beginning here, okay? Back up just a little bit.
Mm-hmm.
So let's distinguish between flipping houses, which is a business, and rental real estate, which is an investment. Okay,
Mm-hmm.
So flipping houses, you're actively involved in the houses, you're putting them on the market, you're fixing them up, you're putting them on the market, you're selling them. You don't get any depreciation because your real estate basically is inventory. So we don't get to take depreciation on inventory. And so flipping houses, anybody who's flipping, wholesale, any of that kind of stuff, that's not what we're talking about right now. We're talking about you're either using it in your business, meaning that let's say that you have an office and you're using that office, you own the office building, you're using it in your business, or you're renting it to somebody else. So it can be commercial real estate, can be residential real estate, can be multifamily, could be single family, as long as you're renting it and actually making money basically over time as opposed to because of effort. So flipping houses, think that's because of your effort, whereas renting houses, you're making money because of time. So if you're making money because of time on your real estate, then we get this amazing benefit. And this is true all over the world, by the way. Every country has a form of depreciation. Some of them call it cost recovery, lots of different words for it. In the US, we call it depreciation. And what that means is that over a period of years, the government says, well, we expect that you're going to get wear and tear on your property, and therefore we're going to give you a deduction for that wear and tear, regardless of whether it actually has wear and tear. So they're just going to make a presumption that you're going to have some kind of wear and tear, and they're going to give you a deduction for that. So your property could actually be going up in value, but even though it's going up in value, you're still getting a deduction for the depreciation because of the wear and tear that your tenants are putting on this property. Okay, and any of us who have property know that tenants do put wear and tear on our properties. So that's going to happen. So the question is over what period of time are we going to get that deduction? In other words, what percentage of our investment do we get to deduct on an annual basis? And that depends on what it is we actually own. So for example, typically, historically, we own a computer, that's like 5 years, right? We're going to have that for 5 years. It's going to wear out in 5 years. So we're going to depreciate it over 5 years. On the other hand, we have a commercial building, and the government says we expect that to wear out over 39 years. So big difference between whether it's like equipment or furniture or even land improvements like landscaping and sidewalks and outdoor lighting, those are actually 15-year properties. So you think about when you buy a piece of real estate, you're actually buying several different types of property. You're buying the land, which everybody knows doesn't wear out, right? Mm-hmm. You're buying the building, which wears out over some long period of time. And frankly, the government has just said, look, if it's residential, it's going to wear out faster than if it's commercial. Okay, we don't know if that's really true, but we're going to say it does, right? That's what the government says. And then when you buy a piece of property, you're also buying all of the land improvements, and you're buying all the contents of the building. So you're buying the flooring, and you're buying the window coverings, and you're buying the lighting, all of the fixtures. You're buying all of that. Well, those wear out faster. So what a cost segregation does is we send an engineer into the property, and they figure out what percentage of your purchase price is allocated to the different properties that you've purchased in that single transaction. And then your CPA works with the engineer to determine, okay, how do we lump that together for purposes of depreciation deduction? Now, normally, depreciation deduction, like I said, for like contents and furniture and cabinetry and stuff like that, normally it's 5 to 7 years. And like I said, land improvements typically are 15 years. However, new law, 2017, you're going to love this. Land improvements, so typically when we do a cost segregation, we find land improvements, and this is just an estimate, folks, so don't use these numbers. You must have a professional cost segregation done. But typically we find that a combination of land improvements and content is going to be about 30% of your purchase price. Okay, well, here's what happens in 2017. Since 2017, your contents and your land improvements can be deducted in year one fully. That's called bonus depreciation. So consider this. Yeah, Elliot's like freaking out there. So you got $1 million building. That's a fourplex. I mean, that's not an expensive property, right? Mm-hmm. So you got $1 million building. You put down $200,000 on this $1 million building, right? The bank put up $800,000. Mm-hmm. You put up $200,000, and your deduction first year could be as high as $300,000. So you put up $200,000, and you're getting a deduction for as much as $300,000 in year one. So you want to talk about the power of real estate when you want to build tax-free wealth. You want to reduce your taxes. I'm sorry, folks. The best tax benefit in the U.S. right now is real estate. Period.
Wow. That's some powerful information that I know the audience is going to enjoy. Tom, let's talk about investors that have apartment buildings. Now, okay. Apartment buildings is basically, for long-term wealth. Normally. Right. And let's talk about just the net operating income. Now, when you increase the net operating income, you increase the value to that commercial building.
Right. So think about how any asset is valued, right? Think about, what do you want when you buy an asset? Well, an asset, remember, Robert Kiyosaki's definition of an asset, something that puts money in your pocket, right? So we're not talking about your house. We're not talking about your car. We're not even talking about your bank account, because it tends to not put any money in your pocket either. We're talking about an asset that's actually producing income. Okay, that's a true investment. We're not talking about we're not talking about a long-term buy, hold, and pray, it goes up investment in the stock market, right? We're talking about something that actually produces income. So you have something that produces income. What are you buying it for? You're buying it for the income. So how much are you going to pay for that? Well, that's going to be a combination of two primary factors. How much risk is there involved in that, right? And then what kind of a return are you hoping to get? right? So if you think about a really efficient market, you're thinking about the stock market. Stocks are pretty much typically priced at a return of somewhere between 3 and 4%. We call it a PE ratio, price to earnings ratio, and typically tends to be in the 25 to 30 multiple range, okay? 25 to 30 times earnings is what's going to be the price of the value of the company or the price of the stock, all right? Well, flip that, think about real estate. Okay, so you're going to have rents over a period of time. So what's your value? Your value is going to be whatever that net operating income is multiplied by some factor. Now, what's that factor? That depends on the market. So the way we determine that is we have what we use what's called the capitalization rate. The capitalization rate is simply this. How much income would you have on an annual basis if, compared to what you paid for it, if you paid cash? So if you paid $1 million for a property and you had $100,000 of net operating income, that's a 10% cap rate, 100,000 over $1 million, right? That's your cap rate. If your cap rate goes down from 10% to 5%, your value just doubled, right? Because 100,000 divided by 5 is twice as much as 100,000 divided by 10. Okay. Now the same thing happens if you increase your net operating income. Let's say you have that 10% cap rate, but you go from $100,000 in net operating income to $200,000 in net operating income. Now, instead of being worth $1 million, it's worth $2 million because you have twice as much income. So it's really always a function of income. You know, businesses, if you have a business, your business is valued exactly the same way. It's some multiple of your cash flow. So all investments are actually valued the same way. They're valued as a multiple of your cash flow. It's just we call them different things in different types of investments. So different asset classes. So in a business, it's called a multiple and typically of EBITDA, which is earnings before interest, taxes, depreciation, and amortization, right? Mm-hmm. That's EBITDA. Mm-hmm. That's what we do in business. It's just a multiple of net earnings. In the stock market, we call it a PE ratio, and in the real estate market, we call it a cap rate. But it's all the same thing. So there was a lot there. I hope you're recording this because people are going to want to listen to that one over and over again.
Oh, yes.
Cap rates, I think, one of the least understood. Mm-hmm. So seriously, a few of us Rich Dad Advisors, we were doing an event in Rome. Mm-hmm. In Rome and Italy a few years ago. And we had like 50 pretty well-heeled investors in the audience. And they go, tell us something new. Tell us something we don't know. You know, they were just seriously heckling from day one. And so my buddy Ken McElroy, you know who Ken is.
Yes.
He's a real estate mogul, right? And he gets in there and he goes, okay, so who can explain cap rates? Silence. Not one person in the room who thought they knew everything even knew what a cap rate was. And I will tell you, it is the most important thing you can understand is how does a cap rate work? Because all of your value for your property is going to be based on your cap rate. And everything you're doing to that property is to increase the net income or lower the cap rate because cap rate's based on risks. So everything you're doing has to do with that cap rate. So it's very important that everybody understand what's a cap rate and how does it apply.
That is so true. I bought one of my apartments from a 8% cap rate. 8% cap rate, and when I sold it at like a 6.5% cap rate. So you definitely right about that.
Yeah, so you sold it for more than you paid for it, for sure.
Yep. Wow.
So capitalization rate is just a formula for yielding money.
Yeah, that's all it is. It's just a formula.
Wow. Now, I've seen a fascinating interview. We're going to shift gears a little bit, Tom. I've seen a fascinating interview that you did with Robert Kiyosaki. And y'all was talking about the tax incentives that you get when you invest in gas and oil fields. Can you break that down in layman's terms for the people that are interested in investing in gas and oil fields? What is the procedure in getting involved with that process, and what is the benefits if you want to transfer over to that type of field with gas and oil fields?
Sure. So remember, our basic premise that the tax law is a series of incentives. And so you look at, what does the government want us to do? Well, clearly, based on that bonus depreciation, they want us to invest in real estate. That's pretty clear. What else do they want us to do? Well, the government has long said we would like to be energy independent of the rest of the world. That's long been a policy of the United States. And so in order to do that, there are incentives to drill oil. Now, the incentive is not to buy Exxon stock. There's no real incentive to buy stock. The incentive is to actually produce oil, to produce natural gas. And so if you actually buy an interest, in other words, you have the rights and you're involved in a partnership, or you do it yourself, you go drill for oil and you take all the risks that are involved in drilling for oil, which means that it may not be there. It means you may not get it out. You have price risk. You have a lot of risks when it comes to oil. Okay, so you're going to say, I'm going to go in and I'm actually going to drill for oil, or I'm going to invest with somebody else, a professional who's going to go in and drill for oil, and I'm going to own a percentage of what's called a working interest, which is the interest I own in working that oil well. Okay, it's a working interest because you're working the oil well. It's not a royalty, so it's not, you don't own the land necessarily. What you do is you own the actual rights to the oil underneath, and then you typically pay the landowner some kind of a royalty. So if you do that, the government says, look, we know that that's a lot of risk, and we're willing to share that risk. Well, the way they share that risk is by giving you a deduction the first year for all of the expenses that you have outside of your actual equipment when you first decide to drill the well. So you don't even have to drill the well yet. You just have to drill it within a few months, okay? And those are called intangible drilling costs. Intangible drilling costs are deductible 100% when you invest the money, when you start the process. So what that means is you could invest $100,000, and the very first year you could have intangible drilling costs of $80,000. Now, here's the thing. Let's say that you invest early enough in the year that you actually drill those wells. The other 20% is probably going to go to equipment, which we have bonus depreciation on. We just talked about that for real estate. So what that means is you literally, at least over the first couple of years, you put in $100,000 and you get a deduction of $100,000. Now, if you're in a 40% tax bracket, that deduction of $100,000 could be worth $40,000 to you, which means that you're taking 60% of the risk and the government's taking 40% of the risk. All right, and that's really what's going on. You're taking 60%, the government's taking 40%. Now, what's cool about oil and gas is when the income comes back, it doesn't come back, you're not taxed on 100% of the income. You're only taxed on 85% of the income. So they give you a benefit going in and they give you a benefit coming out. And that's just because that's a huge incentive. Now, here's what's different between oil and gas and real estate. In real estate, you have to be a professional investor in order to get that deduction. That bonus depreciation, you have to be a professional investor, or you have to have other passive types of income that qualify and allow you to take that depreciation deduction. Not so in oil. In an oil well, you get that deduction even if you're a doctor and and all you did was buy an investment in an oil well. You still get that full deduction. There's no limitations on that deduction as long as there's one little catch: you're a general partner. So you can't be a limited partner. You can't own it through a limited liability company. You have to be a general partner and take on that risk, which hopefully the developer has insured that risk very highly, okay? But you just have an interest directly in the oil well, in the production of the oil, and you get the deduction really within the first 2 years, it should be equal to your investment in that well. Now, that's not as good as real estate. If you're a real estate professional, remember, real estate, I put in 100,000, I might get a deduction of 150 the first year. Whereas in oil and gas, the most I'm going to get if I put in 100 is get 100 back.
Wow. Wow. Okay. Okay. So now when you invest in oil production, I mean, do you got to have deep pockets? Can you start out with a $100,000 6-figure check, or?
You know, you can actually start out. There's some that will take $10,000. You do not have to have deep pockets. I'm very familiar with a number of developers that they have public offerings, and so you can put as little as $5,000 or $10,000, and you just have to go to your broker. Just go to your regular broker, your regular stockbroker, and if they work in the oil and gas area, they should be able to find you an investment in oil and gas. You don't have to have 100,000. You could have 10,000. You don't even have to be an accredited investor.
Wow. Okay. Now, for the people that don't know, can you break that down in layman's terms? What is an accredited investor?
So thank you for asking that, Arthur. An accredited investor is somebody who has money that they can afford to lose. That's basically what it is. Okay.
All right.
Right? Elliot's laughing. He goes, yeah, that's what it is. That's why I have all these pro athletes that they go, oh, I put some money here and I lost money. And I put some money here and I lost money. Well, they get to do that because they're accredited investors. There's a very specific rule. An accredited investor has a net worth if you're married, net worth of $300,000 outside of your house. $1 million outside of your house, or an annual income of $300,000. So it's basically a net worth of $1 million or an annual income of $300,000. So it's not a huge threshold anymore. I mean, a lot of people, inflation means that they've got a lot higher income, so they're actually closer to the accredited investor threshold than they were before. But that's basically all it is. All they're looking for is do you have some kind of a knowledge, that a good syndicator, which is the developer or either the oil and gas developer, the real estate developer, they will ask you questions about what your experience is in investing, because they don't really want, they prefer not to have rookies in their investments because rookies tend to cause problems. They're worried about, is it going to make any money? If you invest, I love looking at oil and gas, what they call an offering, a private offering memorandum, a POM, because typically what it says in big bold letters on the front page, it says, you will probably lose all of your money. Don't get into this thinking that you may not lose all of your money. And they're really clear on that. I mean, it's literally big, bold, capital letters that they tell you. So an accredited investor basically is somebody who can afford to lose the money if the investment doesn't pan out. And that's really what it is. But the returns can be significant. A good syndication, you should be returning somewhere between 10 to 20%.
Now, how do you feel about REITs, real estate investment trusts? But I know when you get involved with that type of investing, you don't own the real estate investment trust.
So let's look at it this way. Think about it this way. When you go shopping, would you rather buy something on sale, or would you rather pay retail price?
Sell.
You'd rather buy it on sale, wouldn't you? If you could buy it wholesale,
what I do, I try to look for a buy. I look for something on sale.
Yeah. You want to look for something on sale. How good would it be if you could buy it wholesale? You would buy it wholesale, wouldn't you?
Oh, I'll pay everyday price on Sunday.
Absolutely, because it would be half the price. Because typically wholesale is half the price of retail. Now, what if you could go directly to the manufacturer and buy it? Would that be even cheaper than wholesale?
It would
Yes,
be
it
cheaper.
would.
Yeah, in fact,
Yes, it
it's going to
would.
be about half the price of wholesale. Well, investing works just like shopping, only the reverse. Okay? So a retail investment, think about this. If you're developing your own property, you're doing your own real estate, for example, you are the factory. You're actually developing that property. Now, as soon as you go to the whole, so that's kind of the factory direct level. So you're going to get the most return on your investment when you actually do it, when you're actually involved in it directly. Same with your business, right? Your business is going to produce that because you're building your business. Now you go to the wholesale level. The wholesale level, that's your accredited investor. That's your syndication. Now what's happening is the syndicator, they're actually doing all the work, so they're getting half the profit, and they're sharing the other half of the profit with the investor. So basically, you're paying twice as much as if you did it yourself, but you're still paying wholesale price. So you're getting a pretty good return on investment. Now let's go to retail. Now retail, you got another person taking a cut off of the top here, right? Retail, now you got the retailer that's taking the cut off the top. Real estate investment trust is a retail investment, just like a mutual fund is a retail investment. So what happens is that your price goes up, which means your return goes down. So if you've ever thought of it this way, typically if you go to a financial planner, they're going to tell you that the most you could ever, in fact, by law, they can't tell you more than this. The most you could ever expect would be 7 to 10%. Now, in reality, most people only do about 3% on their stock market investments. But, okay, let's say 7 to 10%. Well, that means if you could get that exact same investment, but at the wholesale price, you'd double your rate of return. So instead of 7 to 10%, you'd be getting 14 to 20%. What did we just say about a syndication? You should be in that 14 to 20% range. Okay, now you go say, no, I'm going to do the real estate. I'm going to learn. I'm going to get my education. I'm going to actually do the real estate myself. Now, again, you're going to double that return again. So instead of 14 to 20%, you should be getting 28 to 40%. So if you hear somebody say, look, I'm investing in real estate, I'm getting a 30% rate of return, don't be thinking this is impossible. They're not getting 30% of return on a REIT. They're getting 30% of return on the property that they're developing and they're putting together and they're managing and they're handling themselves. And that 30% return makes all the sense in the world because that's the equivalent of a 7.5% return. Do the math. It's the equivalent of a 7.5% return in the retail market. So if you're going to do a REIT, that's great. That's retail investing. Personally, if you can, okay, and you're either an accredited investor. So if you're an accredited investor, an accredited investor, frankly, should never invest in a REIT because they can invest at a wholesale. Why would you pay retail when you can pay wholesale, which is what an accredited investor gets to do? That's the great benefit of being an accredited investor. You get to pay wholesale prices for your investments. Okay? Then you take one step down, you go, wait a minute, if I can get the education and actually learn how to do the investing myself, I could get 30 to 40% returns on my investment with actually no more risk and in ways a lot less risk than retail investing. Why? Because you have control over the investment. If you're a retail investor in that REIT, do you have any control over that investment whatsoever? How much control do you have? Zero. Zero control over that investment. Why? Because you're a retail investor. Somebody else is doing that. You have no control over it. The only control you have is buying and selling. That's it. Whereas at the wholesale level, you're in a private syndication. You're in a private offering. So you can actually talk to the developer and say, wait a minute, I don't know about this. What about this? What about this? You actually have a lot more control and a lot less risk at the wholesale level. If you're doing it yourself and you actually have the education, your risk goes way down. So really, the function is, it's a function of education. The higher your education, the lower your risk and the higher your returns. Okay, you invest in retail because you don't know any better, because you have no education. That's why you invest retail. Same reason you pay retail prices at the store. You don't know where to find a wholesale. If you knew where to find that $3,000 suit, or I should say $5,000 suit that Elliot's wearing, if you know where to find that for a wholesale price, or you can get that direct from the factory, that's what you want to do. But if all you know is retail, you're going to go pay $5,000 for that suit. Investing works just like shopping. It's the same thing.
Wow.
Does that make any sense?
That makes a lot of sense. Yeah, that definitely makes a lot of sense. Tom, now, I know that active investors and real estate investors and, people are the uber wealthy. They don't invest in 401ks. And some people 401ks are turned into one-on-one-ks. Can you break that down in layman's terms about the 401k and what is the benefit of having a 401k? What's the deficit of investing in a 401k?
So the benefit of 401k is you really don't have to know anything. That's the benefit. You don't have to learn. You don't have to take the time. You turn your money over to a money manager and you just, you buy it. You hope it goes up. You hope and pray that it goes up in value. That's it. So that's the real benefit of 401k. It's really easy. You get a deduction up front. So you're deferring the gain, the income to a later year. And so you're going, wow, this is great, right? And your employer probably matches it to some point. So all that sounds really good. Well, so here's the flip side of a 401k. You ready for this?
I'm ready.
Flip side of this. Who controls how much money you put into a 401k?
The economy.
The government.
Right.
The government decides how much you can put into a 401k, right?
That's
Who decides what you can invest in the 401k? The government. Who decides when you can take that money out? The government. Who decides how much tax you pay when you take it out? The government. Who controls every aspect of that, pretty much every aspect of that investment? The government. So if you don't mind the government controlling your investing, if you don't mind the government controlling it, 401ks are fine. Okay? You're a retail investor. Remember, you're going to pay full price for that investment because 401k is in the retail market, right? Now, let's say you didn't invest in 401k. Let's say instead you took that money and you invested it yourself. You're no longer limited to the retail market, are you? Instead of being in the retail market, you could be in the wholesale market, or you could even be in the factory direct market. You could actually end up with 4 times the return with less risk. Here's the downside. You actually have to know what you're doing. You have to know what you're doing. So if you don't want to learn how to invest, if you don't want to learn how to build wealth, you should absolutely be maxing out that 401k. If you're willing to take the time to get the education, to learn how to invest, you learn how to use the tax benefits. Here's the other thing. So think about this one. So let's talk about tax benefits for a second of 401k. Everybody thinks they're so great from a tax standpoint. If you invest in a 401k, it's going to go in the stock market, right?
That's right.
That's where you're investing. All right. So there are 2 types of income you get in the stock market: capital gains and dividends. Okay. Capital gains and dividends, they're taxed at half the rate of ordinary income, right? They get half the tax rate, unless you do it through a 401k, and then they get taxed at the full tax rate. So instead of paying 15% on your dividends, you pay 30 to 40% on your dividends. Instead of paying 15% on your capital gains from your stock investing, you pay 30 to 40%. So you got to go, look, I got a trade-off. I can postpone it, but I'm going to pay higher tax rates when I do pull it out. And guess what? You have to pull it out. And you don't get to control it. You can't just give it to your kids. You can't, it's just there. I mean, you have literally no control over that. You have no control except to say which mutual fund you want to put it in, right? So if you're willing to take the time to invest, from a tax standpoint, you're better off not being in a 401k. From an investment standpoint, you're way better off not being in a 401k if you're willing to get the education, if you're willing to do the work, if you're willing to take control of your life. If you're not willing to do those things, then you should be in a 401k.
Wow. Now, when you want to pull out early with your 401k, they tax that as ordinary income, correct?
It's always, no matter when you pull it out, it's taxed as ordinary income. If you pull it out before you're 59 and a half, on top of the ordinary income, you pay a 10% penalty. Lovely.
Wow. I see why the government created it. So basically 401ks are just for employees.
401ks are for employees, and they actually are a very important part of the stock market, because why do you think, where does all the money come for the stock market? It comes from 401ks, right? That's because the money goes in every month, and they have to put it in every month. Even if the market's in a tumble, you're still putting that money in every month, right? Even if the stock market is just taking off and you're way too high a price, your money's still going in every month, right? And the stock market actually depends on it now. It depends on you putting that money in the 401k. There was a great interview on CNN, Wolf Blitzer, years and years ago. You've probably seen it, Arthur, where Robert Kiyosaki is calling the real estate crash of 2008. He called that crash in 2005. 2006, somewhere around there. He did this interview, and Wolf Blitzer was on, and then Jean Chatzky was on. And Jean Chatzky, my favorite part of this interview is she goes, look, we depend on people putting that money in the 401k. You're saying that this is going to crash, but if they pull it out, it's going to crash faster. And she was absolutely right. Okay. The stock market depends on people putting their money in the 401k, employees putting money into the 401k. That doesn't mean you should do it. It just means that the stock market does depend on it. The 401k is the best thing that ever happened to the stock market.
Wow. Tom, I really appreciate you coming on the show today, because the whole premise of this show is to educate entrepreneurs and business owners and real estate investors that they can live the life that they truly desire, but they have to be open to these important principles. So I don't like what I see what's on the news, so I create my own news.
There you go. I love it.
Tom, can you explain to the audience in your own influential way, what is the best advice that you have ever received?
Oh my heavens! The best advice I've ever received. Be careful of the people you spend time with. That's actually, and I got that advice when I was a teenager, and from a church leader actually. And it was actually, I took it as a warning, be careful of who you spend time with. And I seriously, I've not had that question, Arthur. Thanks for the question. But honestly, I think that's the best advice I've ever received. And I received it when I was a 16-year-old.
Now, I'm very careful and very selective of the people that I surround myself with. I surround myself with great people like Brandon, you, Tom, Elliot Jackson. I mean, we making moves constantly, just on the grind every day, just with meeting people and, just putting transactions into motion. Now, let's talk about brainstorming and how important it is for entrepreneurs and business owners to brainstorm to take those ideas to the next level. How you feel about brainstorming?
Well, if you're talking about getting together and discussing ideas, I think it's with other entrepreneurs. I think it's very, very important. One of the things we do in our network of tax advisors is we get together on a monthly basis to discuss the issues that each tax advisor has, each accountant has in their own practice, because they're all practicing. They all have their own practices. They're all independent business owners. And we get together and we discuss them every month. We just had a live, we do once a quarter, we meet together in person and spend a day together. And we did that last week. And I got to tell you, the ideas that come out of there, you got 10 people there who care about you. As long as it's, to me, it has to be the right space, right? Because if you get with people who are going to, tell you what to do and criticize you and everything like that, I don't know about you. I don't need that in my life. I have no need for somebody to tell me what to do. I'm an entrepreneur because I don't like people telling me what to do. So I don't want a bunch of people telling me, don't do this, go do that, go do this, go do that. What I'm looking for is ideas to build for everybody to share and actually build, a better life for everybody. So I'm a big believer in sharing. Brainstorming can be something, frankly, I actually think sometimes it's a complete waste of time. If it's not well directed, if you don't have a good facilitator, a good moderator helping with that brainstorming, frankly, I think most brainstorming is a complete waste of time. I think there are those situations. What we do in our network is we create a safe space. So we have some very specific rules that I'm willing to share with you if you're interested.
Yes.
Would you like to know?
Yes.
So, and I give credit where credit's due. These are absolutely stolen from YPO, Young Presidents Organization. Okay, I have a couple of buddies who are members of YPO, and I asked for their help when I was starting this network, and they said, yeah, here's a couple of rules that we have, and we're very strict on these rules. First of all, nobody gives advice, ever. So we come with our issues, but nobody gives advice. All they do is share experiences. And what that means is that nobody's telling anybody what to do. They're saying, here's what I did in when I was encountered that situation. Here was my experience, but I'm not going to tell you what to do. You just learn from my experience. So that's number one. Number two is no notes. Nobody takes notes. There are no notes, because number three is what comes up in the forum stays in the forum. You don't talk about it with your spouse. You don't talk about it with your friends. You don't talk about it with your business partner. Unless it's your issue, right? Your issue, you talk about anything you want. But if it's somebody else's issue, what goes to Vegas stays in Vegas. Okay, so we use the Vegas rules when it comes to our forum. So those are pretty simple rules, but I'll tell you what, we have amazing sessions where each person gets one of their major issues basically solved, but they're solved through experience. They're not solved through advice. And I love that, because I want a safe space. And I think that's when you have a safe space, now all that good positive energy, all that good intellectual capacity can be used, and you're not worried about somebody, tromping all over you. Because I've been in those. I mean, you probably have too, Arthur. I've been in those mastermind groups. I see heads nodding here. You've been in those mastermind groups where they say, well, bring your big problem. Then they come in and all they do is pound, 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 pound. I'm just going, that does not help me. Does not help me. Whereas if I come in and say, well, tell me your experience, it's like, if I want to, somebody says, well, I don't know how to, I don't know how to build systems in my business. I don't know how to do that. And I'm going, and I say, well, what happened to me is I didn't know how to do that either. And it turned out that when I bought an accounting firm, they had all those systems. So I basically bought the systems. So that was my experience. I didn't tell them you should go buy an accounting firm. I said, look, here's my, I'm not going to tell somebody to go buy an accounting firm. I'm saying, here's what happened in my situation. So that's an example of how that works. I just think when you have if you have the right brainstorming or the right discussion group, I think it's amazing. If you have the wrong one, I think it's awful.
So ideas is the real capital of real wealth?
Oh, no question. Well, ideas and knowledge, education, all of that. Yep, for sure.
Tom, I talk to entrepreneurs all the time, and they always looking forward to building a business that they can sell.
Okay.
When you're building a business and you want to sell that business, for entrepreneurs and business owners that are in the market of buying businesses, should they buy businesses that have strong cash flow, a strong EBITDA, or should they buy a business for just strictly cash flow and looking forward to building that book of business?
You got to look at, why are you buying the business? Okay. Well, why are you, why are you looking for a business? Why are you buying a business? Okay. First of all, I would never buy a business I wasn't familiar with. Okay. I pretty much want to know that business. So the only businesses I'll ever buy probably are accounting firms, right? I know that business. So I'm comfortable buying an accounting firm. Buying some other business just makes no sense to me, right? So that's the first thing. And then the question is, okay, the big question is that cash flow repeatable? So in other words, once the owner leaves, is that cash flow still going to be there? It's a big issue in my industry, for example, because if a CPA's been the accountant for their clients for 20 years and they leave, are the clients going to stay? I don't know. So I better build that into my purchase price, knowing that some of those clients are probably going to leave because they don't know me from Adam. So they may absolutely leave. And I bought several accounting firms over my lifetime, and I've sold several accounting firms, and not all the clients stay. That's the way it is. So that's true in any business. The biggest thing I can say, if you're building a business, is make sure that the business you're building is one that can work without you. Doesn't need you. If the business needs you, then it's not worth nearly as much as if the business doesn't need you. And I would look at it that way from the buying side too.
Wow. Okay. Tom, let's have a discussion about delegation. Now, I know the minimum wage of a millionaire is around $524 an hour. So I always tell my audience, what can you delegate for $524 an hour? Or you can go way beyond that. What can you delegate that's within your current budget? How important it is for entrepreneurs and business owners to delegate tasks out that they're not currently good at, so they could just focus on increasing their top line revenues in their businesses?
Well, the difference between somebody who isn't a millionaire and a millionaire is just how you use your resources. And frankly, the difference between a millionaire and a billionaire is how you use your resources. So the only resource that you have a limited amount of is time. You can get money. There's trillions of dollars out in the economy that are obtainable. Okay. So money is replaceable. Time is not replaceable. So how much is your time worth to you? So here's my rule. Every day I look at what I've got to do that day and I'm going, what could somebody else do? And if anybody else could do it, I want them to do it. I look constantly at replacing myself. Constantly, I want to replace myself. I'd like to replace myself as a speaker. I'd like to replace myself as an educator. I'd like to replace myself with clients. I want to replace everywhere I can replace myself. I want to replace myself. Well, that takes some time, right? So what we start with is we look at those things that are pretty easy to replace. For example, some of our listeners, your listeners, are probably doing their own bookkeeping. What a waste of time. Okay, that's $20, $30 an hour work. Okay, let somebody else do it. There are probably some entrepreneurs who do not have a personal assistant. That's a huge mistake in my opinion. My absolutely most important person in my life, in my business life, is my personal assistant. And she takes care of everything. Seriously, we would not, and you know this, Arthur, we would not be on this call were it not for my personal assistant, because I don't have time to be answering those emails. I don't have time to be looking at that stuff, at everything that comes in, because I get lots and lots of requests. And I don't keep my schedule. My personal assistant keeps my schedule. Everything I can delegate. Everything I can delegate, I delegate. And let's be clear. This is not a dump and run. Okay? Meaning I'm not just going to turn it over and say, you go do this without any direction. My assistant knows very clearly that, you send me an email, say, would you contact Arthur, find out what this is about? She contacts you. What's she going to do? She's going to come back to me and say, okay, here's what it is. Do you want to do it? Then I say yes. I didn't dump it on her. She knew what I wanted. She had very specific direction, and she went and did it. Okay? So, I hate it when people dump. I hate it when they dump and run. That's not delegation. So you want to really get something done, you want it done the right way, make sure that you give instructions. Make sure you're there available to do training. Because delegations, to me, the great thing about delegation, it's an opportunity to train. So I'll tell you a secret. I hate doing things that aren't repeatable, that I do once and it's done. Okay. So I mentioned, I hope you're recording this, because I would hate it if people were listening to this and then it weren't recorded and more people couldn't listen to it. Right. I was doing training with my tax team this morning, my little CPA firm, and I was doing training with my tax team. What do we have? We had, I don't know if you're familiar with this new technology, this owl. It is like, seriously, Arthur, it is like one of the coolest things I've ever seen. Have you seen it?
Yes.
So it's got a 360 mic and a 360 camera, and it actually picks up, the camera goes to whoever is talking. It was fantastic. Yeah, Elliot, yeah, it is. Check it out. It's called the Owl. Okay. So I am unabashed promotion here because we used it this morning. A buddy of mine gave it to me last week. And so I'm recording this this morning because I don't like to do training without recording, right? Because I got all these other CPAs. I got my CPA firm, but I got dozens of other CPAs that I need to be training. So I want to be recording that so that I can turn it into a course so that they can get my training. So I don't, I turn everything into a product. Every single thing I want to do, I want it to end up being a product because then it's repeatable. I can use it over and over again. So I'm doing this training this morning. I'm okay with that. I'm okay using my time that way. I could have had one of the staff do the training, but I couldn't have had one of the staff do the training and have it be good enough training that all of our network members could use it. So now I'm doing it and I'm repeating it. So what you have to think about is when we're thinking about delegation, think about how do we get bigger? How do we use our time better? Okay. I look at $524 an hour and I'm going, oh no, if something only cost me $524 an hour, I guarantee you I am delegating that. Okay. Because my time's worth way more than $524 an hour. Okay. That is my billing rate it's been a long time since my billing rate was only $524 an hour. So, so I'm not, I want to do it myself. Now I may want to do it myself, maybe something that I'm learning, maybe, I may want to do some research just because I love doing research. I love researching the tax law. But I'm gonna do it in such a way that I can use it over and over and over again. That's the thing. We've got to make ourselves bigger, Arthur, as entrepreneurs. We've got to stop doing things ourselves. We really have to delegate. We have to delegate. But there's a few key people. I mean, a personal assistant, even if you start with a virtual assistant, I mean, it's inexpensive. Get somebody in the Philippines that's charging you, $5 an hour or $5 a day or whatever the going rate is. Okay. My personal assistant comes to my house, comes to my office. I mean, she, if I needed her to pick up my laundry, she'd pick up my laundry. That's she's a personal assistant, okay, not an executive assistant. So she does personal tasks. And the reason is because that frees me up to do other things that are of higher value to the business. All right. So I can do like this. We're reaching, thousands and thousands of people, right, Arthur? So I do something like this. I'm reaching a lot more people, right, than if I were having a phone call one-on-one with somebody. So that's why my billing rate's so high, is because, if I'm one-on-one, I'm only getting paid by one person, not by thousands of people. I'm not spreading the word to thousands of people. I'm spreading it to one person, which is fine. I'm happy to do that once in a while, as long as it's interesting. But that's something I don't even take on clients unless there's some kind of a relationship that I really want with that client. It's not just I don't sell my time like that. It's not worth it. It doesn't matter what the rate per hour is.
Wow. Tom, we covered a lot of ground here about cost segregation, building wealth through real estate investing, building wealth through, gas and oil fields. Now let's talk about my favorite topic, money. Now I know money is not value. Money is just a facilitator to do transactions. Can you explain to the audience, how would you define money?
Debt. Money's debt. Okay. So think about, why does the government not tax you when you borrow money? It's debt. How does money get created? Through debt. When we had a crash in 2008, why did we have a crash and almost a depression? Why? Because all those foreclosures took money out of the system because the debt was extinguished. Okay, so money is debt. It used to be, gold, silver, other things, but now it's debt. Okay, so that's really what money is. It's just debt. And the only reason it works is if people believe in it. So it's also confidence. So money's a combination of debt and confidence. And when you think about that, it's pretty scary. You'll look at it that way.
Now, I hear your buddy, Robert Kiyosaki. He always says this all the time, Tom. He says, cash is trash. Can you break that down to the audience so they fully understand why is cash is trash?
Well, yeah. What he's when you hear that cash is trash, all you're saying is that cash that's just sitting there is not doing you any good, or probably isn't doing you any good. So think of it this way. We have inflation, which means that every minute your dollar is worth less than it was a minute ago. As we've been on this call, our dollars are worth less than they were when we started the call. So it's not making you money just sitting there. So what Robert's really talking about is savings. All right, now, when the time is right, the person with the cash is going to be the person who wins. Because when real estate crashed in 2008 and 9, let me tell you, the people who made all the money were the people that had cash. All right. So it's not that cash is necessarily trash. Cash is not always trash. It's that cash is, think of it this way. The purpose of an asset is to put money in your pocket. Is your cash putting money in your pocket? That's the question. Now, if you're holding it because you go, look, I'm willing to deal with a little bit of inflation for a year because I think this market's going to crash, then you're making money, because when that crashes, you're going to be ready and you're going to pick up all those bargains. Okay. So you're just waiting for the sale. That's all. You're just waiting for real estate or business or whatever to go on sale. I think in my business, for example, I think CPA firms are going to go on sale. I absolutely think they're going to go on sale, because you got a bunch of old people, like old white guys like me, who are about to sell their CPA firms, and guess what? There's not there's going to be more supply than there is demand. So I think they're going to go on sale. You know, if I decided that I want to buy a whole bunch of CPA firms, like our friend Gordon was talking about, guess what? I'd be waiting for them to go on sale. I wouldn't be buying them right now. Okay.
Yeah,
and so then, right?
Mm-hmm.
So then cash can be valuable. That's when you want to have cash. Now, here's the flip side of that. There's a lot of people have been predicting a crash, including my friend Robert. Okay. Let's say it doesn't crash and you've been sitting on that cash. Now you've been losing money. So it's a fine line. You really have to pay close attention to how invested are you with your money. I mean, to have money just sitting around, I mean, large proportions of your wealth sitting around in cash. That's a challenging thought. I'd like to be invested, because if it's sitting around for 3-4 years, then I've lost a lot of opportunity. My opportunity cost, I'll never make it up in a crash. Right, I'll never make up 4 years of opportunity cost in a crash. On the other hand, so like let's say that you had a bunch of cash in 2010 and you were waiting for the next crash because you thought, oh no, it's going to go down and just keep going up, 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 up. Right? Well, you just sat on your money and your money's just lost value. You could have had it invested. So when people say cash is trash, I think it just means that, for the most part, you want to be investing your money. Now, Robert would say, look, I think he would say, you just can listen to his stuff. He can say it himself. But, he talks a lot about gold. If you're going to have money that's just sitting there, gold and silver probably makes more sense, because they don't ever lose their value, right? They may lose purchasing, they never lose purchasing power. They may lose price. So the price of gold goes up and down, but the purchasing power of gold doesn't really vary much up and down, right? So if gold goes down to $400 an ounce, like Harry Dent says it's going to, well, that's probably you're still going to be able to buy the same amount with an ounce of gold as you could when it was today, when it's $1,300 an ounce. Right? It's just you're going to be in a depression, so you're going to be able to buy a lot more with a lot less money. If it goes up to $10,000 an ounce, it's still going to be, you're going to buy the same amount with $10,000 because everything else has gone up, right? So gold's just a store of value. It's just a better store of value than cash. Mm-hmm. So if you're really going to store value, the challenge with gold is it's got a high transaction cost, right? I mean, it really, for the most part, it's got a pretty high transaction cost. So when you buy gold, you pay a premium. When you sell gold, you pay a premium to sell it, right? So you have to be a little careful there. This is something that's a store of value. It's not something that you are planning to use right away. If you're planning to use your cash right away, you're waiting for, like you're looking for the right investment opportunity, it's fine. What you may do instead, though, is think about paying off debt and then getting, let's say you have a house that's got a $300,000 mortgage on it. You could always pay down that house. Then at least you're making whatever the mortgage is, and then take out a line of credit. And a line of credit's available for you to use. So that's free. So there are ways that you can use your cash so that it's always working for you. But I think that's all anybody's talking about when they say cash is trash, is don't just let it sit around. Do something with it.
You mentioned the power of gold and silver. So gold is hoarded and silver is consumed?
Well, silver is consumed, but silver is also a store of value. Okay, the difference between gold and silver is gold's not used as often in industrial processes. Silver is used a lot in industrial processes. So silver is used up more. And so there's an argument that silver is more valuable compared to gold, than really the price would indicate. The challenge with silver is transporting it. I mean, you have very much, the same amount of gold, right, is a lot smaller lot easier to transport. So silver is just hard to transport because it's so, it takes so much of it to make up the same amount as gold.
Mm. Yeah, I know some people in my network, and I invest in the 1 ounce American Eagle silver coins. And I had some people in my network where they bought a lot of monster boxes in the past, where, they were just buying up silver. And it seemed like it's a thin line with silver today. Like, how do you feel about, investing in monster boxes with having a lot of silver in your pipeline?
I don't look at silver as an investment.
Mm.
I don't look at silver and gold as an investment. They're store value. They're an insurance. They're insurance. They're buying insurance.
Mm.
And frankly, not a whole lot different than if you went out and bought whole life insurance. Frankly, whole life insurance pretty much mirrors inflation, by the way, as it goes up. It pretty much mirrors inflation because the insurance company is investing it basically to keep pace with inflation. So, yeah, to me, it's just insurance. It's just insurance.
Wow. Tom, from your own perspective, and I know you travel all over the world, and when you speak, people listen. Now, let's talk about the power of using video. Now, I know a couple of years back, Google bought YouTube for $1.6 billion. So video is hot right now.
That was a screaming deal, wasn't it? I mean, think about it. Think about what a good deal that was.
Yes, it was.
That was a really good deal.
Can you explain to the audience the power of using video? Should entrepreneurs and business owners use video to expand their brand?
I think we should use all of the tools available, whatever works for your audience. Videos are hot right now. You used to be that podcasts were hot. Now video podcasts are hot. Mm-hmm. And who knows what tomorrow will be. What we do know is that, different people learn different ways. And some people are going to learn from video. I don't watch video, personally. Okay. Frankly, I'd rather read. So it doesn't work for me. I don't have the patience to sit and watch a video. I just don't. So maybe if I'm looking up how to, how to trim my toenails, might want to look up a YouTube video on how to do that, right? But because I got a short little video, we use a lot of video in our training, but we use it along with transcripts and lessons and interaction and live calls. Like I do 2 webinars a month where people get to ask me questions. Okay, so we record that video, but they get to ask me questions. And I think live training is also important. I think it's important to do simulations. I think that, frankly, if we could do everything through games as opposed to video, audio, reading, anything, I think we'd be a lot better off. So we learn best through simulation. And video's not bad, but it's not the same as having a discussion, or it's not the same as doing a simulation. It's better, I think, than for most people. It's probably better than reading. Mm-hmm. I just think we ought to use everything. I think we ought to use everything at our disposal, because I think as entrepreneurs, if we have a product or a service that we believe in, we have an absolute obligation to get it out to the world. Mm. So, people used to say, well, Tom, you just like to sell. I said, no, I don't like to sell. I just have a message that I believe strongly that the world needs. And so whatever I have to do to get out and get that message to the world, I'm going to do.
Mm. Wow. Now, I know Warren Buffett and Charlie Munger, they are value investors. And they don't basically buy, technology companies. They only buy and purchase companies that they fully understand. So right. Active investors, when they invest into a business, they don't buy a business because it has assets. They buy a business because it has earnings. Would you agree with that?
You know what? You'll have to ask them that question. You know, I know why I buy business. I don't know why anybody else buys a business, right?
Right.
I mean, but I think you're right. I think, why would you ever buy a business you didn't understand? You know, people talk about value investing. That's just what we were talking about. Do you buy retail, wholesale, or factory direct?